Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. So today we're back with Dino, fabulous co-host. Thanks, Dino, for joining.
Hey, Axel.
And we are joined, our guest today is Alexandre Rossi, who's a very successful real estate investor, started with some condos in Griffintown and then pivoted towards some multifamily. So we're going to jump right into it. But before we do, I always like to remind you who's listening, your support is really important in spreading the good word. And if you want to support us in getting better and better guests, please leave us a review, share it with a friend. Send us some feedback. It's always good to hear about what is it that you care about and how we could improve the show. So thanks for taking those 2 minutes. It really goes a long way. So, hey, Alex, welcome to the show.
Thank you for including me today.
Look, it's a pleasure. We met a little while ago, and I was quite impressed with your track record and story. And I was hoping to so we could actually share how you got into being so successful. Let's just say it bluntly. And so, first of all, like, how in the world did you get started in real estate?
I kind of stumbled, actually. The story's interesting. A $90,000 condo in Laval, a basement condo, a 400 foot, 3.5 condo. I think I bought it when I was about 20 with kind of the money I had saved up. And that's actually before the Griffintown days. So I bought this $90,000 condo. I mean, can you imagine 90 grand? Like, you can get you get a parking space for that in Toronto today. But anyway, I bought the cheapest thing I could afford, and it was cash flowing, and I was happy. And then, a couple of years I sold it only at about 120 grand. So I didn't make a terrible amount of money, but I just realized how interesting the rates of return were, not only from a cash flow perspective, but also like on a return on equity with the uptick in the value of the property relative to the down payment I put, which was only 10%. So I thought from a financial background and from a financial perspective, the returns were incredibly compelling. And then from then on, I'm like, well, what's next? And then I kind of learned about the Griffintown, sector and the pre-construction. And I'm like, oh, I've never dabbled in the pre-construction, but I was interesting. And I saw vision in terms of a great neighborhood close to the city. And so I signed my first deal. I was actually on a break at JMSB. This was in 2014 or 2015. And, I bought that condo at like 200,000, which was incredibly affordable if we look back today. Yeah. And then, 5 years later, it had almost doubled. So it was just interesting to see how buying an embryo had gained so much in value. And, now today I'm actually living in Griffintown. So it's interesting that 5 years or 6 years later, I'm kind of back to where it all began. And throughout the last 5 years, I bought, some condos here in the same buildings just because I love being by the canal. And I've kind of refinanced and scaled and then, pivoted into the multifamily, which we can discuss later.
Sure. And so you're investing, I was going to say, but you have a full-time job. Like, this is kind of still a side gig for you. So what do you do for a living?
Right. Yeah. So I work 40 hours for an employer, and then I work probably about another 30 or 40 hours for myself, which is pretty much the real estate space. For a living, I wholesale investments to brokers in the province of Quebec. So I'm wholesaling mutual funds and exchange trade funds for, client retirement accounts or TFSA accounts and all the different vehicles we have available in Canada. So that's my full-time gig.
Okay.
I have a finance background, a finance degree. I have an MBA, and I'm also a chartered investment manager. That's my, 9 to 5 day job. And then my real estate is kind of what I do on weekends or evenings or, vacation.
Okay. So you have a strong background with numbers.
Correct. That's kind of what helps. And what I love really about real estate, it's truly a game of numbers and negotiation. I mean, it's you need to be good in those two and get really good at knowing the numbers and how to negotiate. So those that like those two aspects, I think, will be very successful in the real estate game.
Again, a people's business, huh?
As always.
Everything is. Yeah, absolutely.
Okay. So that's funny. Some people go out at the bar on the weekend and you work on your real estate Beautiful. Is that the
I
plan
mean, I
on the
can do
lot?
it from there too, because emails come in and tenant problems come in. I need this, I need that. And,
Love it.
sometimes after a few drinks, the problems could be, worse or not as worse. So who knows?
So you manage your properties.
I do manage a couple of my condos in Griffintown just because it's more viable and it makes more sense to kind of manage that. But for my multifamily, I'm not involved at all. I just oversee things, and I get an update from time to time, but I don't hear of any of the headaches and I don't hear of any of the problems, and I don't care to. So I've fully delegated all that, which I believe is a key ingredient to being able to scale.
100%. If you're answering tenant phone calls, you're not looking for your next deal and you're not looking for funding and so on. It's absolute. It's a choice. You're absolutely right. So you started with this one condo in Laval. You sold it, and then you went to Griffintown with another one that you bought on plans. And then, like, how did it go from there? Because you've acquired actually quite a collection. You're still young. Like, can you kind of walk us through that process?
Right. So, I mean, the timing was impeccable in the sense that I had gotten into the Griffintown space, right around 2015. And then the market had really heated and gone up. And then what I did was I pulled out equity and, took out 80% of that 200 grand. So then I had, 160 grand to play with. So then I bought two more condos, and then, those also went up in value. And then I pulled out equity to buy more. So it's kind of like, in a sense, my babies are multiplying, that's how I like to say it. But it all started with one. And if you can't start with one, you can't have two, and you can't have 20, and you can't have 200. So the moral of the story is to just pull the trigger, get the first one if you're interested, and then good things happen to those that, stay focused.
You were talking about cash flow at the beginning with the condos, and believe me, I'm all about cash flow. So
yeah, you must like Grant Cardone in that case.
I also like Grant Cardone. But my question to you is, buying condos with the price of the rent and now the price of the condos in Griffintown, with the HOA fees or the condo fees or whatever you call them, you're still cash flowing good with those properties?
So given I bought them like cheap, they do cash flow. Someone who's going to get into the Griffintown space today will be very, very difficult to cash flow unless you're buying small units like 500 feet, which is kind of the sweet spot where I'm seeing, still a break even. But once you start getting into the condos at like 700 or 800 square feet, you're looking at, values of north of 500 grand, and then a mortgage servicing that mortgage debt, you're probably not going to break even. So it is becoming very difficult in the Griffintown, in the Montreal, in the core. Most investors that are buying there are simply speculating that prices will continue to rise with the development of the REM and, just the fact that real estate keeps going up. But I'm, giving advice to be a little bit more cautious in the sense that if prices don't keep going up, well, you're going to be held with an asset that's not even cash flowing. So you're maybe not in the best financial position.
And you, as you said, like, it's actually really difficult to compete with owner occupants because they don't care. Like, debt servicing may be a little bit high, but they're happy to live there. They have their 9-to-5 job and stuff like that. Whereas you're trying to make money. If you need to squeeze a margin, you also have to be real estate. You can't be charging $4,000 a month for 600 square feet. So like, you're absolutely right. For you, it made sense because you started a while ago and you got them for actually cheap relative to the current prices. But yeah, for someone coming in now, like, the margin would be thin or inexistent.
No, absolutely. And that's kind of what made me pivot into, bigger projects and the multifamily, which you get cheaper per door and you kind of get interesting rents when you leave the Montreal area. So that's what I decided to do. And the same success I had in the pre-construction space in Montreal, Griffintown, I'm seeing now actually in Gatineau, which is another incredible market. And I'm seeing some good opportunities for the next 3 to 5 years there.
Mm-hmm. Actually, yeah, let's talk about that a little bit. So after like a few condos here in town, you went to Gatineau, and like, why there? Why multifamily? Kind of, what was the shift in your head?
Yeah, so I have actually one of my best friends that lives in Ottawa, Gatineau area for schooling. And so we've always kind of looked at that market from a numbers perspective. And we always saw that we're like, how come the properties are like half price, but the rents are like almost the same? The ratios and financials are so much more compelling. So a lot of people kind of neglected that market, and they're like, oh, it's never going to go up. It's cheap for a reason. Things that are cheap stay cheap, which I don't necessarily disagree with. But I nonetheless took a leap of faith in that market because I kind of saw, what's going to be the next market. It's close to Ottawa. Eventually, investors are going to want to buy things that have good cash flow and that can qualify with smaller down payments. So I took that jump a couple of years ago, and again, that was probably the best decision I made, probably even better than Griffintown. So I was moderately successful with the first one I bought in Laval, and then pretty successful in the Griffintown market, and then the Gatineau is just like I hit the jackpot. Now, like I wish I had done more, and you kind of always look back and you're like, oh, I wish I would have done more.
Not too late.
Yeah, it's not too late. And with mentality, we'd all be billionaires and sipping margaritas on a yacht right now. So
yeah, it doesn't always happen that way.
Exactly.
So are you alone in that project, Alex?
Yeah, I am. I've been successful doing it alone and kind of just putting my money where my mouth's at. And now people are, interested in what I do and coming to me. And I'm actually doing a deal with another affluent partner. So we're putting our resources together to really buy some interesting stuff together, bigger. And then I think that'll be kind of like a template or a model for us or myself, depending on where we go together to really scale. And then I can get into buying, 50 doors or 100 doors. And now that I have all the, infrastructure put in place with my bankers, my property managers, my accountants, my residential brokers who help fund the deal sometimes, I have all that, my lawyers, I have all that infrastructure in place, and I have a very, very good, solid network of competent people. Now it's just a question of being able to scale. I'll ask for money and I'll need, investor capital for me to do all the work and then kind of share those deals together and share those returns together.
And feel comfortable to share whatever it is, but so with this new deal that you're doing with a partner, kind of roughly what's the asset and how you're structuring it together?
So essentially what we're doing is like an 80-20 capital allocation, where that individual is committing 80% of the capital and I'm committing 20% of the capital, just so that we're both vested. And then what we're doing is buying a pre-construction multifamily project. We anticipate, a 20 or 30% uptick in that value, which is a substantial amount. Perhaps we could share on a different call together. Or did you want me to just share it? Yeah,
sure.
We'll talk. I mean, we're looking at north of like $1 million of uptick. So it's an interesting amount. And then what we're going to do is refi after 1 year and then basically take out that $1 million, or let's say 850,000. And then after that 1 year, what I'm going to do is pay back my partner the 30% that he had overpaid as a down payment. And then we reset the playing field back at zero. And it's a win-win in the sense that together we would not have been able to make $1 million together because he would not have had the contacts, the resources, nor the developers to do it. And I may not have been able to do it just for the lack of capital. So it's a real win-win. And I like that 80-20 structure. And I believe for someone who wants to get into the space with absolutely no knowledge, it's definitely worth it because they'll get paid their additional down payment after, let's say, 18 to 24 months. So it's a model that I think is very interesting, and I would love to keep reproducing that.
It's actually a really good idea. I like it. So I just want to make sure I understand. So you guys are going in it together. He's putting 80% of the capital, you put 20, and then you do the project. When you refi, you take your share and you buy him back basically 30%. So you guys are at 50-50?
Well, we just take the equity out of the building that as it goes up in value. Mm-hmm. And then, for example, whatever the partner put in more than I did not put, basically we take from that refi money to give him more of the money to reset it back to level playing field.
Okay. And then you guys are going 50-50 in the future.
And then we just own the building 50-50 forever. And all the cash flow and all the uptick going forward is just 50-50, and it's simple.
After you just multiply.
Yeah.
Do babies.
Exactly.
Yeah. That's a really good idea. I like it. Cool.
So, yeah, we like making a lot of babies, and then they just kind of, they just make them. Eventually, they make themselves for you. You don't even have to do the work.
There you go. So when you're looking for a multi, what are you looking for? Is it like 18 units and up?
Yeah, I like above
Somewhere.
20. Exactly. I think when you go above 20, you get some interesting results. And, whether you go to the notary once or sign a deal once, whether it's 10 doors, 20 doors, or 50 doors, I just feel like it's more worthwhile going for a bigger deal because you're going to have to do all the work, all the banking, all everything, one time. I'd rather go for a 50 as opposed to do, 5 10s.
Absolutely. It's almost the same amount of work whether you're buying a 10 or a 50 anyways. So.
It's the exact same amount of work. Yeah.
So you're basically looking pretty much at always new constructions.
Yes, that's my claim to fame in the pre-construction space. Almost everything I bought except that condo in Laval has all been pre-construction, and that's kind of where I differentiate myself from other, investors in the real estate investment space. That's my niche. That's what I know best. That's what I'm very successful in, and that's what I believe will generate the most handsome returns.
You know what? In a way, you're absolutely right. And I envy you just because I had to deal with like some major plumbing issue in an old building. And I'm like, I just want to do new construction now. I don't want to deal with like 60-year-old pipes and stuff like that. I know we joked about it with Dino a little, for a little bit. And I find it's a really good strategy. It makes sense. And the thing is that you also delay the moment where you're going to have any major capex and any major maintenance and anything like that. You buy, like for the first 5 to 10 years, it's clean.
And the good news is in the first 5 years, you're not kind of caught by the balls, excuse my my terminology, but you're not capped as to what the rents will be. So you don't have like, a 2% cap in terms of how much you can raise rents because you don't know what your expenses will be in terms of municipal school taxes and insurance because they're so in Quebec. What happens is the first 5 years of new construction, it's basically you decide the rent as so long the market could accept what you're wanting to get.
Mm-hmm.
So Alex, you work a 9 to 5 job full time. You're a full-time investor. What's next?
I like this podcast stuff. I mean, if you guys think I did a good job today, maybe you'll have me again. I don't know. What do you think?
I would love to. Well, let you come back in a year when that project is done and we'll dissect it piece by piece. That's a great idea.
It'll be done sooner than that. We can maybe do it sooner.
Yeah.
But do you plan on quitting your job at one point, or you really like having this side hustle, real estate, and working? And
I mean, for where I'm at right now, I can handle both, and I kind of like the balance of both, just because I, have fun in doing my day job, and I like this on the side. Maybe in 3 to 5 years, this could become a full-time gig, and I definitely see this actually kind of forming its own company one day. And as I kind of scale and I have some international people that are coming and saying, look, I like the Canadian real estate market. And who knows, maybe I'll have clients that come to me with the 80-20 strategy and we can, get foreign money from the UK or from the US or from other countries where they believe in the success of the Canadian real estate market.
In terms of completely different question, but in terms of diversification, would you go maybe into like new construction and like high-end chalets that are rented short-term, for example?
The chalet market is not my area of expertise. I don't have any experience. I'm not against or anything, and I do know COVID has really helped increase that price point, but I don't have enough experience for me to give sound advice in that space.
Mm-hmm. Okay, because some of them, like on the higher end, when you see what they rent for, and I'm talking like $10,000 a month. The cash flow is really good, and it's just a question of having the right infrastructure and management in place so that it's really seamless from the owner's point of view, and the cash flow is quite substantial. So I thought it might be an asset class that could be interesting for you to diversify.
No, from a cash flow perspective, it's definitely compelling. What makes me a little nervous in looking at the chalet and those luxury and kind of cottage type properties is that you don't always know what your vacancy will be, right? So if you don't have a 1-year lease, like I'm not sure if someone signs a 1-year lease at a luxury property in Montreal, for example. So if you're vacant 2-3 months, it's great to say, well, sure, I have $10,000 of revenue come in a month, but suddenly like November, it's not really ski season. It's not really, summer, like who's going to rent that and why? So do you have to really bring down that revenue from $10,000 a month to $6,000 And then at that point, it's not really worth. So it's a little bit more of a volatile revenue. And I have more of a track record in very predictable revenues in the multifamily. You know what your rents are. You know, next year they're up between 4 to 7%, depending on what the market can take. And my vacancy is 2%. So it's like, it's almost bulletproof from that aspect of revenue.
That makes sense.
Less of a risk factor, less of a risk taker.
Yes, but the risk is also taken in the pre-construction, right? I'm buying buildings like on a piece of paper, so I've never seen them, or I don't even have a door to walk into.
Absolutely.
Well, I have a few cottages, and I have some high-end one and low-end one, and you're totally right. You can't really guess on your vacancy, but the thing is the income is like 3 or 4 times what you would get on a regular rent. So, and when you do your numbers, it's all a numbers game at the end of the day. So if you do your numbers and at 40 or 50% of vacancy during the year, you're still okay with that. Well, you know what? If you only get 50%, you're fine. If not, you're just making more money. I don't think the risk is that much if it's lower than that, because COVID or not, before COVID hit, we were renting cottages anyways. So I think it's
has COVID made the rental income go up substantially? I know prices have skyrocketed, but share with me a little bit, like what were you renting in 2019 vis-a-vis today?
I cannot answer that because I started buying cottages in COVID. So
oh, I see. Okay, well, do you know if the rents have gone up, like what people are prepared to pay has gone up a lot, or you're not able to comment?
What I see or what I hear is a lot of the occupancy rate is much higher since we can't leave the country. And obviously the price point is higher also because there's a bigger demand. So people can do what they want with the prices because they know it's going to be rented anyways. So I think there was a big increase in the rent and vacancy and the price of the properties because people wanted to buy them.
I had seen that also with an operator in the Charlevoix area who's got some really nice chalets, and they said like prices went up about 20%, but it's just that before they used to have 70, 80 occupancy, and now they're at like 97, and those are like high-end chalets, 4 or 5 bedrooms, you know, top of the line for the market here. So
that's terrific. Like that's a beautiful story. The question that we must ask though is like going forward, I mean, is that going to be forever now, or in 2-3 years are people going to like, I don't want to go to Charlotte, I want to go to the Alps, and suddenly see back a decrease from 90 to 70.
Yeah, exactly. Once the borders reopen, people are going to want to go back to Greece and Italy and Spain, and we don't know what's going to happen here.
That's why you don't buy a cottage looking at numbers saying, oh, I'm going to be occupied 90% of the time. Because at one point, it's not going to happen, you know?
Yeah, and that's why I like your 40 to 50%. It makes sense to me.
All right, wonderful. All right, two last questions, man. What can the audience, what can we do for you, basically? How can we help you?
That's a great question. I'm always looking for investors. I'm always looking for developers. I'm always looking for exposure. So those are probably the 3 things. Probably the number one thing in that is, I'm open to doing deals with people, and I'm opening to help other people build wealth in the pre-construction real estate space.
Okay, so if I have a new construction deal coming up soon, for example, I should give you a call?
Or if you have someone with money, you should give me a call because I already have a pipeline of deals. I get myself on like a pre-VIP list, and it's basically when I get that phone call, I need the check.
Yeah. Okay.
Nice.
Super.
Well, that's a pretty nice niche you have there. Not a lot of people are in that niche, so I'm not surprised that you're having success, and I love the fact that you want to work with people and you're open partnership and helping others. It's pretty cool because it's a specific niche that not everybody's doing now.
Thank you.
And then lastly, where can people find out more about you?
I am on LinkedIn, but that's more for my day job and my career. So they can definitely add me on LinkedIn at Alexandre Rossi. You'll likely find me. And then you can follow me on the gram, Alex Rossi 6 on Instagram. I do have some interesting real estate content. I will be looking to, produce a little bit more in the upcoming months or years, of course. And you'll get to see a little bit about my weekly Psych Wednesday tips that help people become healthier, wealthier, and happier. So it's not only real estate. You'll get a bunch of stuff in there that's fun and humorous, and you can all see me there every Wednesday.
Sounds good, man.
Nice. This guy works a full-time job, full-time real estate, and has the time to put some content on Instagram to help others. That's pretty cool.
I know he's a
I mean,
rockstar.
the more you have on your plate, the more you can handle, right?
Yeah. You get used to it.
Yeah, exactly.
Yeah. Hey, Alex, it's been a pleasure, man. You're a rock star. I look forward for you to coming back on the show, seriously, so we can kind of like see the evolution, and you can give us updates and stuff like that. It'd be fun. So let's plan that in the near future.
Great. Would love to have you include me again in the next couple months or whatever fits best. Thank you very much, Axel. Thanks, Dino, and really looking forward to hearing more about your podcast. And I would definitely want to tune in to the next one.
Sounds good, man. All right. Well, thank you very much, everyone, for listening. In the meantime, be inspired, listen to podcasts, educate, be healthy, and go make some purchase offers. All right. Thank you very much, and talk to you next week. Ciao, ciao.
Bye, guys. Bye, guys.